Somewhere out there, there's a person who woke up on February 1st, 2026, and by midnight had lost $222 million in one trade on Ethereum. That is not a typo. That is the largest single liquidation in the history of decentralized derivatives markets. And the terrifying part is not the number. It's that this person was not reckless. They were following the exact same logic that millions of other traders were using. And they were wrong at the worst possible moment. And what does the mainstream financial media tell you about all of this? That it was a healthy correction, that the market needed to cool off, that this is just the nature of crypto. And I'm telling you right now, that explanation is not just incomplete. It is dangerous, because if you believe this was just a random pullback, you will be completely blindsided by what comes next. So stay with me through this entire video, because the picture I'm about to show you changes everything about how you should be thinking about your positioning right now. Well, welcome to the Wealth Continuum. If this is your first time here, this channel exists for one reason only: to give you the macro level analysis that helps you see what most investors miss before it becomes obvious to everyone. Hit subscribe right now and drop a comment below telling me where in the world you're watching from. Seriously, whether you are in the United States, the UK, Southeast Asia, Nigeria, Brazil, or anywhere else on the planet, this market event is affecting you differently depending on your local currency, your access to exchanges, and your macro environment. I read every comment, and I want to know your perspective. Now, let's get into the real story. Let's start with what just happened, because I want to frame this precisely. Bitcoin peaked at $126,000 in October 2025, a new all-time high that had been building throughout the entire post-halving cycle of 2024 and 2025. Everything looked on track. Spot Bitcoin ETFs had accumulated over $137 billion in assets under management at their peak. Institutional adoption was broadening. MicroStrategy, now called Strategy, was still aggressively accumulating. The narrative was clean, the trend was up, and the consensus view was that the bull cycle was intact. Then, November arrived, and something very quietly began to break. The spot Bitcoin ETF complex, those same vehicles that had been the single biggest bull argument for this cycle, began bleeding capital. November 2025 saw $3.48 billion leave Bitcoin ETFs. December added another $1.09 billion. January 2026 piled on $1.49 billion more. Add it all up, and you get $6.18 billion pulled out of Bitcoin ETFs in just 3 months. That is the longest sustained outflow streak since spot ETFs launched in January 2024. And when ETF holders redeem shares, the fund doesn't just absorb the loss internally. It has to sell actual Bitcoin on the open market into a falling price, which drives the price lower, which triggers more redemptions, which forces more selling. You can see exactly how that feedback loop builds. And then you understand why the move from $126,000 down to $60,000 was not a random drift. It was a structured unwinding. But here's what most investors are missing right now. The ETF outflow story is real. The leverage liquidation story is real. But neither of those is the root cause. Those are the mechanism. The cause is something deeper. And to understand it, you have to look at a room in Washington where a decision was made on January 30th, 2026 that changed the macro calculus for risk assets across the entire financial system. On that day, President Trump nominated Kevin Warsh, a former Federal Reserve governor, as the next chair of the Federal Reserve. Warsh is set to replace Jerome Powell when Powell's term ends in May 2026. And the moment that nomination dropped, Bitcoin fell from around $88,000 to a low of approximately $81,000 in a single session. ETFs shed nearly $1 billion in outflows on that single day alone. The market's reaction was immediate and decisive, because here's what traders understood in real time that a lot of retail investors still haven't processed. Kevin Warsh is known, historically, structurally, as an inflation hawk. He is a man who believes in tighter monetary policy, higher real interest rates, and a significantly smaller Federal Reserve balance sheet. He was so opposed to the Fed's bond buying programs in 2011 that he resigned his position rather than support what he viewed as reckless monetary expansion. That is not a mild disagreement. That is a man of genuine conviction about monetary discipline. And monetary discipline is the exact opposite of what crypto markets need to thrive. Now, and this is important because nuance matters here, Warsh has also said publicly that he views Bitcoin as, quote, a good cop that exposes policy errors. Michael Saylor himself posted on the day of the nomination that, quote, soon Kevin Warsh will be the first pro-Bitcoin chairman of the Federal Reserve. And Warsh has actually invested in crypto companies. So this is not a black and white story of a hostile regulator coming to crush Bitcoin. It is far more complicated than that. But in the short term, in the weeks immediately following the nomination, what the market heard was this: higher real interest rates, smaller Fed balance sheet, tighter liquidity conditions. And for risk assets operating in a leveraged, liquidity-sensitive market, those three phrases translate directly into selling pressure. Stay with me, because the next part changes everything. The Federal Reserve held rates steady at their January 28, 2026 meeting, keeping the federal funds rate in the range of 3.5 to 3.75%. That decision was not unanimous. Governors Waller and Moran dissented in favor of a cut, but the majority held. And the December dot plot, the Fed's own projection of future rate moves, showed only one rate cut expected for all of 2026. One. After markets were pricing in multiple cuts as recently as early last year. The December dot plot is not a promise, but it is a signal. And the signal says, do not expect cheap money to come back quickly. Do not expect the liquidity conditions that fueled the 2024 and 2025 bull run to return on your timeline. Understand what that means for crypto specifically. The entire post-halving rally from 2024 into the October 2025 all-time high was built, in large part, on a liquidity expansion story. Rate cuts in the fall of 2024, expectations of more cuts in 2025, a weakening dollar, capital rotating out of bonds and cash into risk assets, Bitcoin benefiting from both the halving supply dynamics and the macro tailwind simultaneously. That combination was extraordinarily powerful. But now in February 2026, the macro tailwind has not just stopped. It has partially reversed. The Fed is holding. The Warsh nomination has introduced a new layer of hawkish uncertainty. And Bitcoin lost 45% of its value from the top. This is where it gets concerning. And I want you to sit with this for a moment before I move on. The current federal funds rate of 3.5 to 3.75% means that risk-free U.S. Treasuries are still offering meaningful yield to institutional portfolio managers. When you can park capital in short-duration government debt and earn a real return with effectively zero risk, the calculus for holding volatile assets changes materially. Every institutional allocation model has a risk-adjusted return framework. Bitcoin at $68,000 after a 45% drawdown is not the same opportunity it was at $68,000 on the way up. The chart looks similar. The psychology is completely different. And the institutional decision maker sitting in front of an allocation committee right now is asking the same question every time. Why hold this much crypto when the risk-free alternative is still paying? That question does not kill Bitcoin. It does not end the cycle. But it does delay the resumption of institutional inflows. And delayed inflows, in a market where leverage has already been cleared out, means choppy, sideways, frustrating price action, which tests patience, which causes retail investors to exit, which removes buying pressure, which creates the conditions for a continuation of the downtrend. You need to understand this chain of logic before I show you what happens next. Let's talk about what happened on February 1st, 2026, because this single day tells you everything about the internal structure of this market right now. In a 24-hour window, 434,945 traders were liquidated across exchanges. Total losses hit $2.58 billion. And the overwhelming majority of that, $2.42 billion, came from long positions, bullish bets. People who were holding leveraged long positions because they believed the rally would continue. The largest single liquidation in the entire event was that $222 million Ethereum position on Hyperliquid. Ethereum bore the brunt of the liquidation cascade. $1.15 billion in ETH positions alone were wiped out. Bitcoin followed with $788 million. Solana saw approximately $200 million liquidated. Hyperliquid, a decentralized derivatives exchange, recorded over $1 billion in liquidations in that single session, accounting for more than 40% of total losses across all exchanges. Bybit saw $574 million. Binance, approximately $258 million. These are not small, retail-driven numbers. This is institutional scale leverage being forcibly unwound by the market. And when that happens at this speed, in a market where average Bitcoin market depth has already fallen approximately 30% since October 2025, the price impact is amplified dramatically beyond what the raw numbers would suggest. Because here's the truth about liquidity that most people don't talk about. Bitcoin's liquidity, the depth of the order book, the ability of the market to absorb large sell orders without dramatic price movement, has deteriorated significantly since the October top. Analysts at several institutions flagged this as a serious risk in the weeks before the crash. When market depth shrinks and open interest remains elevated, the market becomes fragile, not because of any one large seller, but because the shock absorbers that would normally cushion price moves are not there. The market becomes like a car with no suspension driving over rough road. Every bump hits harder. Comment below if you think the crypto market has found its bottom here around 60,000, or if you think we still have more pain ahead. This is a live debate among serious analysts right now, and I genuinely want to know what this audience thinks. Now let's go deeper into the macro machine, because what is happening in crypto is not isolated from what is happening in the broader global financial system, not anymore. And this is the part that most crypto content creators either don't understand or are afraid to explain. The US dollar has been strengthening, and when the dollar strengthens, it creates a tightening effect across global capital markets that is almost mechanical in its operation. Most of the world's trade and most of the world's debt is denominated in dollars. When the dollar gets more expensive, when DXY pushes higher, the dollar-denominated debt gets more expensive to service for foreign governments, foreign companies, and foreign banks. Capital that was deployed into emerging markets, into risk assets, and into crypto gets pulled back toward dollar-denominated safety. This is not a new dynamic, but the timing of dollar strength relative to where Bitcoin sits in its cycle creates a particularly difficult environment. Look at what is happening in Japan, because the yen carry trade is a force that most crypto investors have never considered, and it has been a significant factor in global liquidity dynamics for years. The Bank of Japan spent decades holding interest rates near zero or even negative. Investors around the world learned to borrow cheaply in yen and deploy those borrowed funds into higher returning assets elsewhere, including crypto. When that carry trade is stable, it is effectively a hidden liquidity pump for risk assets globally. When it becomes unstable, when the yen weakens dramatically, or when the Bank of Japan moves unexpectedly on rates, that carry trade unwinds. And the unwind shows up as sudden, seemingly unexplained selling in Bitcoin, in equities, in anything that benefited from the carry capital. We saw a violent preview of this dynamic in 2024. The situation has not resolved. The Bank of Japan is still navigating the most delicate monetary policy transition in decades. Layer on top of that what is happening in China. The Chinese property crisis has not been resolved. Consumer confidence in China remains under pressure. And the Chinese government, while trying to stimulate domestic activity, is managing significant currency pressures simultaneously. The renminbi's relationship with the dollar creates its own feedback loops for global capital flows. And those flows, in complex and partially restricted ways, have historically intersected with crypto demand. In periods of global dollar strength and Chinese economic stress, that intersection shifts in ways that are not supportive of crypto prices. Now here is the larger point, and I need you to really hear this. The Federal Reserve, the Bank of Japan, the European Central Bank, and the People's Bank of China are all navigating completely divergent policy paths simultaneously. The US is holding rates at 3.5 to 3.75 with enormous uncertainty about the Warsh-led future direction. Japan is slowly trying to normalize rates for the first time in a generation. Europe has been cutting. China is cutting aggressively to stimulate its economy. When the world's four most systemically important central banks are all moving in different directions, global capital flows become unpredictable. Currency volatility increases. Liquidity conditions in every asset class shift faster than most investors can react to. And crypto, because it is the most globally liquid, borderless, 24-hour market that exists, becomes a pressure release valve for all of that stress simultaneously. It goes down when the system is stressed, because it is the most accessible thing to sell, and it goes up when the system relaxes because it is the most accessible vehicle for deploying aggressive capital. Right now, the system is stressed. That stress is showing up clearly in the Crypto Fear and Greed Index, which printed a reading of 8, extreme fear, in mid-February 2026. Historically, every time this index has stayed below 10 for more than 5 consecutive days, Bitcoin was higher 12 months later, every single time. That streak is now being tested, but the historical pattern is real. If you believe a fear and greed reading below 10 is a signal long-term investors should study, not run from, hit like. Now let's talk about ETFs, because this is where the short-term pain and the long-term thesis sharply diverge. Spot Bitcoin ETF assets under management have fallen to roughly $97 billion down from highs above $137 billion. During this February sell-off, US-listed spot ETFs saw $272 million in net outflows in a single day. On January 30th, the Warsh nomination day, nearly $1 billion exited in one session. BlackRock, Fidelity Investments, and Grayscale Investments all saw redemptions. That is not retail panic. That is institutional risk management. But here's the part most people are missing. Even during the worst outflow days, BlackRock's IBIT continued attracting capital. The largest, most regulated Bitcoin ETF in the world kept seeing inflows while others were bleeding. That's not noise, that's signal. When the most institutionally respected Bitcoin product continues pulling capital during a 45% drawdown, it tells you something about the durability of the institutional thesis. Now, layer in the broader view. JPMorgan Chase published a note in mid-February saying they expect recovery this cycle to be institutionally driven, citing clearer U.S. regulatory frameworks. Meanwhile, Standard Chartered warned Bitcoin could retest $60,000 with conviction. And Coinbase reported a $667 million loss in Q4 2025, with revenue down over 20%. The infrastructure felt this correction deeply. Now here's the number that matters most. U.S. money market funds are holding roughly $7 trillion in assets. $7 trillion parked in short-duration, yield-paying cash equivalents. That capital did not exist at this scale during prior Bitcoin cycle highs. When rates fall, when inflation cools further, when risk appetite returns, even a small percentage of that capital reallocating changes everything. 1% of $7 trillion is $70 billion. For context, the entire crypto market cap for most of its history was smaller than that. A single percentage point of institutional reallocation could be transformational. This is why the short-term story and the long-term story are completely different narratives right now. The short-term story is painful. The long-term story is quietly building. Let's walk through 3 forward scenarios. Scenario 1, base stabilization. Bitcoin holds $60,000 as a structural floor. The leverage built between the October high and February lows has largely been flushed. The market consolidates. Choppy, frustrating, testing patience. In this scenario, Warsh is confirmed as Fed chair. The Fed signals 1 or 2 cuts in the second half of 2026. Inflation cools gradually. Bitcoin slowly reaccumulates. It doesn't feel like a bull market. But historically, this is what precedes one. Scenario 2, macro deterioration. Extension, $60,000 fails. A hawkish surprise from Kevin Warsh, sticky inflation, or a broader credit event pushes Bitcoin toward $50,000, possibly even the high 40,000s. Painful? Yes. But every major Bitcoin bear market has been followed by a new high. The investors who bought during the 2022 collapse to $15,000, during the implosions of Luna, Celsius, BlockFi, and FTX are already sitting on massive gains. The question isn't whether volatility happens. It's whether you're positioned to survive it without leverage. Scenario 3, the Warsh pivot. Surprise. This is the one markets aren't pricing. Warsh takes the Fed chair seat in May and signals faster cuts than expected. Softening labor markets, cooling inflation, growth concerns, and he pivots. The dollar weakens. Liquidity expands. In Bitcoin, building a base during extreme fear reprices violently upward. That's when some portion of that $7 trillion begins to move. That S, when ETF infrastructure, already embedded in institutional portfolios, becomes the highway for capital flows that retail investors aren't a T ready for. This scenario isn't consensus, but surprises are what create generational returns. Now let's ground this. Bitcoin at $68,000 is still down 45% from its $126,000 all-time high. Ethereum fell from $3,500 to $1,146 at its February low. Standard Chartered warned of further downside. The fear and greed index hit 8. Coinbase posted major losses. The pain is real, but so is the history. Bitcoin survived the 2018 collapse from $20,000 to $3,000. It survived the March 2020 crash. It survived the 2022 bear market from $69,000 to $15,000, alongside FTX and systemic failures. Each time, those who managed risk and avoided leverage were still here for the recovery. Now zoom out even further. The global monetary system is shifting. BRICS nations are building alternative payment rails. Saudi Arabia is accepting non-dollar currencies for oil. China is expanding the renminbi's global reach. U.S. fiscal deficits are forcing record treasury issuance. None of this means the dollar collapses tomorrow. But it does mean central banks and sovereign wealth funds are studying a multipolar monetary future. And Bitcoin is increasingly part of that conversation. Not as a meme, not as retail speculation, but as a neutral, scarce, non-sovereign asset. The 45% drawdown is real. The ETF outflows are real. The $6+ billion in redemptions are real. But so is $70 billion from just 1% of institutional cash. So is IBIT's resilience. So is the fact that Bitcoin remains dramatically above where it traded a year ago. The question is not whether Bitcoin survives this cycle. History has answered that. The question is whether you understand your risk exposure well enough to still be here when the next chapter begins. Because investors who exit at the bottom don't just miss the bounce, they miss the next leg entirely. So before you buy, before you sell, before you react emotionally, ask yourself, do I understand why I own what I own? If the answer is yes, and your position reflects conviction rather than emotion, you're ahead of most of the market. If the answer is no, that's valuable information too. Because in markets like this, what you don't know is always more expensive than what you do. Subscribe to the Wealth Continuum if you want real macro depth, not daily noise. And share this with someone who needs to understand the difference between short-term volatility and long-term structural change. Because right now, that distinction is worth real money.